Welcome to the Route Consultant Wednesday webinar. We are glad you found us. If you're new, welcome. Hopefully you learn a lot from us today. If you are a regular returning client, we are glad you're not tired of us yet. So thanks for joining us. My name is Bridget Cresta. I am the Associate Director of our consulting program here. Later on, I will be joined by Mr. Danny Robinson. He is one of the regional sales directors here on the Route Consultant team, and he's going to be running through some information about tax advantages and implications for FedEx Ground routes specifically. But before I get to all that, I have to read our fun little disclaimer that some of our regulars can probably rattle off verbatim, and then I will get to some event highlights, new listings we have coming out, and then our content today. So first, Route Consultant is not endorsed by, is not recommended by Federal Express Corporation, FedEx Ground, or Amazon. Route Consultant is not sponsored by, is not approved by, is not associated with, and has no connection whatsoever with Federal Express Corporation or FedEx Ground or Amazon. Okay, so now that I'm not going to get in any legal trouble, I wanted to highlight a couple of events for you guys that are coming up. One really important one is happening this week, actually, on Friday, this Friday, from 10 a.m. to 12 Central Time. We are hosting a virtual webinar. This is going to be our back office vendor workshop. So basically what this is going to be an opportunity for you guys to hear from vendors in the space that work with FedEx and Amazon routes all the time, and contractors to set up things like insurance, trucks, payroll, safety technology, any of that kind of stuff. You're going to get an opportunity to hear from these vendors. So if you're looking to purchase any one of these businesses in the next 6 months, this is going to be a great opportunity for you to kind of get your foot in the door and start learning about some of these things that are going to be required for you to have before you're even able to stand up as a contractor. So we'll drop the link for that in the chat so you can register. Again, that's this Friday. We also have our Expo 2024 ready to go. This is going to be in July. So you have a couple months. Go ahead and book your flights. This is going to be down in Dallas, Texas. I'm excited. I've been to Texas quite a few times because my in-laws are down there, but we will be in Dallas this year. It is August 3rd and 4th. We'll drop the link for that as well. Always lots of good content, super fun party. Plus you get to meet me and our awesome team at Route Consultant in the flesh. So great opportunity for you there too. And we also have a link to book your rooms through. If you know that you're going to go, I would go ahead and book your room as well, because we usually run out and have to add some more blocks on later. Sometimes those have a higher price. So if you know you're going, just go ahead and do those too as well. All right. So we just have 2 listings this week that I wanted to highlight for you guys. Hang with me and then we'll get to that tax content I know you're all here for. This first listing, though, is out of Central North Carolina. This is going to be 25 Amazon routes listed at $549,000. This is only around 19% of revenue. This is currently operating around a 12% EBITDA margin. It's going to come with 6 spare vehicles. This is an efficient operation with multiple managers in place to run the daily operation. This service is a highly residential and affluent area. And if you didn't already know, Amazon provides a full service leasing program to reduce the variable costs, expenses associated with your vehicles. So that's always very nice. Something that the FedEx space does not have. And our next one that I wanted to highlight for you guys is going to be out of Kansas. This is a 10 line haul run operation listed at $3.25 million. That's right around 53% of revenue. This one is also operating around a 12% EBITDA margin. It's going to be 10 unassigned team runs. Unassigned runs provide lots of opportunities in the FedEx space, but really it's a great opportunity to accumulate line haul points. And if you have questions about what you can do with those and how that works, you can pop that over in the Q&A box, and we'll ask Danny about that later. This business in Kansas is going to come with 2 full-time managers on staff to handle daily operational tasks of the business. And it looks like they have some leased vehicles in their fleet as well. So that's going to help with repair and maintenance costs, to just have that fixed expense. So that's it on our events and listings this week. Now, without further ado, I will introduce Danny Robinson to come on and talk about tax implications for FedEx Ground. Danny, we are all ears.
Thanks, everybody. And thank you, Bridget. I really appreciate you giving me that ringing endorsement. Let's start off my expert testimony by saying I am not an expert on taxes. I'm not a tax professional. I'm not a CPA. You should always engage those professionals when you're going through the due diligence and the decision-making process with your FedEx Ground routes. But as a well-tenured member of the route consultant sales team and someone who's very proud to be working for a company that has well over 10 years of experience in the space, we do have some knowledge about the advantages and the implications of taxes when it comes to these routes. So we're going to go over a couple of different things today. I think that the best place to start when talking about this is where we start when we have a new buyer making an offer on a deal in the entity that you choose to house this operation inside of. So FedEx is going to require that you have either an S Corp or a C Corp that you house this business inside of, right? And there's very different strategies and implications for your taxes depending on what you choose there. More often than not, we're going to see these deals run through an S corporation. That is the standard, and that is what we typically recommend. There are, however, times when a C Corp is necessary, particularly if you're going to be using Rob's 401k funding for the majority of the acquisition or for your capital injection to achieve a bank loan or an SBA loan, whichever you're going to go with there. The big note here is that C corporations will have to file their taxes on Form 1120. S corporations can do the 1120S rather, but S corporations are going to file their taxes similarly to a sole proprietorship or a partnership. So there are some real differences there in the way that you will handle and be taxed. Neither of those are going to have a huge effect on some of the advantages and the tax advantageous nature of the FedEx Ground businesses that we broker, right? So on the business financial side, when we're talking about tax implications, a big thing that we always come across when people are going through the process and vetting businesses and wondering how to set up their corporation is they look at the financials that are provided from the business, which is a no-brainer, right? But accepting these financials at face value is a mistake, and one that we're going to always steer you in the opposite direction of, right? The advantageous tax-wise nature of these businesses constantly makes it look on paper like these businesses are taking a loss when in fact they are not. There is a huge amount of depreciation that goes into running these businesses and how you keep your financials, your balance sheets, and your P&Ls and all of your tax records, obviously. And again, contact your CPA or your tax professional on how to do this stuff. But you hear it all the time in the business world where if you've got a good accountant, it should never look like you're making a profit. The fact is, in the FedEx Ground space, it's very easy to do that, because of the heavy and aggressive depreciation schedules that you're going to take with your assets, and because of the high cash through model that these businesses operate inside of. So a lot of cash coming in, a lot of cash going out. I mean, when you look at the P&Ls, anything that we provided to you on the projections or the prospectuses for the businesses that we're brokering, you're going to see that, right? When we see businesses that are running 20% margins or so, clearly there's a lot of expense that's going into the business, but still a lot of profit left over, right? The majority of contractors, additionally, they run a lot of personal expenses through these businesses. They can run their personal fuel costs, their personal cell phones. Obviously, there's salaries and distributions that they can take. All sorts of different things like travel expenses, food and entertainment. You'll see these items accounted for on almost all of the P&Ls, and zero of that is going to be a carried forward expense that you'll be obligated to realize as an investor in this space. So traditionally, when we go through these things and we account for add backs, that's the difference that you're going to see between the company provided P&Ls and our projections is we're going to add back things like amortization, like depreciation expenses, like owner's compensation, or any major personal expenses that are being run through that business entity, right? So accepting those financials on face value really does leave you in a precarious situation where you may not be getting the full story. You may not be getting a full realization of the profitability or the opportunity that that contract represents. And as it relates to taxes, yes, the tax returns are very often, if not always, going to look as though a business is taking a loss. But when you really peel back all the layers of that onion, you see the same profitable businesses that we mark on our website and through other ancillary listing sites every single day, right? And when it comes to the structure of purchasing these businesses, we've talked a lot about this in the past. I think Bridget and I have even been on webinars before where we talked about seller financing and how to set up and structure specific deals in creative ways to help avoid some taxes that you might incur here, right? So 90% of the deals that we do here at Route Consultant are going to be governed by an asset purchase agreement. They are an asset sale, not a stock sale. Stock sales do make up a small percentage of our deals here, and they do have a purpose. There's a reason for those, but there's also a very viable reason for why we suggest and prefer to do these deals via an asset purchase agreement. And a big part of that is through a stock sale, you're going to assume and inherit the depreciation that the business has already been running. Whereas with an asset sale, we can assign an appropriate and justifiable value to the fleet, and you can start a fresh depreciation schedule that's going to be hugely advantageous on the tax side to you as a new investor into that space. That's how you can be very cash positive in the way that these businesses run without that huge tax burden that comes along with it. So very important thing to keep in mind there. With a stock sale, you're inheriting that schedule. You're not going to be able to start over again, and there's going to be a very specific depreciation amount that you're going to be able to realize, and it will limit you somewhat in filing the following year. And so from a seller's perspective, I think it's important to note here as well, keeping clean records is crucial to being successful with navigating the exit strategy that you've built out for yourself, right? Running too many of those personal expenses that we talked about is going to greatly diminish the profitability as it sits with your tax returns and how things look on paper. Is that really the end of the story? No, of course not. We just talked about that. But it will greatly diminish the ability for you and I to work together as seller and broker to get the highest value for your deal, especially if it's one that's going to be going through the banking systems or the SBA. If you guys are keeping kind of muddied financials that have a lot of personal expenses and you're being a little bit too creative in your accounting there, right? So keeping clean financials on the seller side is huge. And let's talk again real quick before we jump into the Q&A stuff. Capital gains tax is one of the largest looming clouds over the sale of one of these businesses. If you've been in this space for as long as some of our contractors have, 10, 20, 30 years, you definitely didn't pay for the business what we're going to help you sell it for. The capital gains of that are real, and they can hurt real bad if you don't handle those the right way. You don't have an appropriate strategy to navigate that. Obviously, again, talk to your CPA, talk to your tax pro, but also talk to me and let me and my team here help you guys structure a deal that has an appropriate amount of seller financing attached to it. Because the way that we really like to structure those is on a longer amortization schedule with a balloon payment about halfway through there. And that will give you several years where capital gains does not need to be realized by you, and you can offset some of those expenses and even diminish that tax burden as you go through the 5, 6, 7 years following that sale, once you start to realize those seller financing payments. The overwhelming majority of the deals that we broker here at Route Consultant have seller financing attached to them. And we do that for a number of reasons: to help with the cash flow, to help with the deal structuring, to make the deals more bankable, and ultimately to make sure that we're doing what we committed to do when we very first started working with our seller. And that was to get you the best possible deal for the business that you scraped and worked so hard to build. Offsetting your capital gains tax by allowing seller financing inside of that deal structure can absolutely help you in that regard. The last thing I wanted to talk about tax-wise from the buyer's perspective is some of the closing costs and taxes that are going to be related to standing up your business. I know last week Josh did a great job talking about the startup costs when it comes to buying one of these businesses. But as we're just a week removed from that and talking about taxes now, I think it's relevant to talk about the sales tax for the vehicles, especially that you're going to be acquiring through these deals in an asset purchase agreement. Upwards of, with some deals that I've broken, we're talking, $40,000 and $50,000 in sales tax on these fleets. that is a significant amount of money that you need to be prepared for in your operational costs at stand-up. But the good news is on that front that in the partnership that we've worked so hard to build with G Bank, should you finance your acquisition through that, our preferred SBA lender, we're actually have worked with them over the past year, and we've got a great program with them where we're actually financing some operational capital and the closing tax costs as far as the sales tax for the trucks are concerned into those loans, so you don't have to have that liquid in your pocket at closing. It's something that we can be hugely helpful to have that 4 weeks of operating capital plus the sales tax and transfer costs for the vehicles. So on top of the sales tax, you've got your registration fees and everything else that the DMV is going to want to nickel and dime you out of. So if it's something that concerns you and you're worried about the cash flow, the operating capital, and the cost to close that deal, talk to us a little bit more. We'll introduce you to Tucker Herring and our friends over at G Bank, and we can talk about financing those expenses into your SBA loan if that's the route that you're going in your acquisition. So with that being said, I think that's pretty much all I've got on the tech stuff. I'm really excited to get into the Q&A on this stuff. Bridget, how are you feeling?
Pretty good. And I forgot to mention at the very beginning, which is totally my fault, but you guys, most of you guys are return clients. So if you have questions, pop them in the Q&A box, not the chat box. If you put it in the chat, we probably won't see it. So any questions, they could be operational, they could be tax specific, they could be about the Friday vendor event. We actually did have one question clarifying the time. So the event this Friday for the vendor workshop, back office vendor workshop, that is from 10 a.m. to 12 Central Time. And that link is in the chat to go ahead and register for that. But yeah, I'll let you guys start loading your questions in. But Danny, I have kind of a question, or like, what are your thoughts on the long-term capital gains when you're trying to think like tax purposes? I work with some of our mastermind clients, and they were thinking about selling one of their businesses, and it's relatively new, but I'm pretty sure if you sell within the first year, you will be taxed as just like an ordinary income instead of that long-term capital gains. Is that what you've heard? Is that true? I'm pretty sure.
That is 100% my understanding, and it's a great question. The longevity and the timeline of how long you've owned a business, there are varying tiers of capital gains for that. The longer you've owned something, the higher the tier goes. And this is federal policy; it's not state regulated. It's pretty readily available to get some of that baseline information out there. But if it's a scenario where you came into the space, you were maybe awarded a CSA by FedEx Ground, you turn it around from a failing operation to a successful, profitable one in like 6 months, your capital gains are going to be significantly minimal if you've owned that business less than a year. So yes, you're absolutely right. The long-term capital gains are going to be a real gut punch. But again, there's ways that we can structure deals creatively to help you guys out with that. And we can obviously be as transparent as we need to and as open as we need to with your tax professionals and helping them strategize how to reinvest those dollars to avoid some of those tax pitfalls.
And especially if you do it really well, like that would be a much better option, owning the business for at least a year, and that's from when your contract goes, effective day one. Then you could do the long-term capital gains instead of the ordinary income, which could be, 30% higher than what you could normally be taxed as. So
that's absolutely right. Yep.
Yeah, it's pretty crazy what they can do there. But okay, so we have a couple questions rolling in. I'll stop chatting and see what you guys actually want to hear about.
You can chat anytime, Bridget. I'm all for it.
Thanks, Danny. All right. This first one is from Zach. Zach wants to know some information about seller financing. Honestly, Danny, I think it would be nice to hear from you as, someone who works with the sellers and the buyers. First, I'm going to add this on to Zach's question, but what are you seeing in the seller financing for buyers and sellers? Like, are sellers more comfortable this year than they have been previously? And then for Zach's question, what's the tax method for seller financing? If you can elaborate at all there, kind of what you were thinking at.
So I'll touch on what you said first, Bridget. I mean, the nature of seller financing and the deals that we're brokering, like I had just said, upwards of 80 to 90% of our deals have some aspect of seller financing attached to them. It is a huge part of the strategy that we take on here at Route Consultant in the best interest of both buyer and seller. Sellers are apt to provide that as needed. It's obviously not a lot of people's first option, but there's so many benefits on the sell side to it as well. I mean, the overall earnings that you make are higher than the sale price of the business because our average interest rate is about 6% on those seller notes right now. So an extra 6% on what your sale price is doesn't hurt. Like I said, the advantages on putting off and mitigating some of those long-term capital gains taxes because you've structured that seller financing over a longer amortization period with a balloon payment maybe halfway into that. It's a really great way to like I said, avert some of those tax pitfalls that you can run into. And Zach, to your point, the way I'm reading your question and I'm understanding it is that you're asking what's the method of paying taxes on the seller financing you receive. And that's kind of the way I'm taking that. If I'm wrong, let us know and we can take another crack at it. But when you're receiving seller financing, that's ordinary income for the most part. You can work with your CPA to strategize the best way to house that, whether it's an EFT into your bank account, or if you want to house that into a corporation, however you want to do that, there's a lot of different ways there. But your seller financing is essentially going to be taxed as any other income would.
Okay. Next one we have here is from Charles. Charles wants to know, do you have any suggestions on year-end strategies, such as front loading of expenses that we should be thinking about? Any kind of strategies?
That's it seems like a little bit of a loaded question there, Charles. I don't want to give you too much tax advice. I don't want to wade into that specific venue. But the end of the year is a great time to make sure that you're capitalizing on the revenues that are coming into you. There's a high revenue period right now, peak season, right? We all know about it. We all love it. It's kind of a nightmare for operators sometimes, but they love the money at the end of the day. Using the capital and the revenue that you're driving in right now is a really, really great opportunity for you to make sure you're ahead of the game on your vehicle maintenance and things like that going into Q1 of next year. Obviously, there's going to be a lot of different things happening in your operation. You're going to be heavy on payroll going into January. You're going to be heavy on fuel and maintenance costs because of the overusage of your vehicles during peak season and the extra drivers that you had to bring on. So end of year suggestions is kind of hard because at the end of the year, you're going to be pigeonholed into being successful for peak season. That's the time of year when you're making the most of your money and FedEx expects the most out of you. So really strategizing earlier in the year on how to maximize your earnings into your tax strategy is the right way to handle that. But just making sure that you're capitalizing on the increased amounts of revenue that you're taking on right now, keeping your fleet in tip-top shape, and obviously picking the best contract drivers that you have available to stay on payroll after peak season is smoothed out. And then, of course, going into next year, like I've said a few times, working with your CPA and your tax professional, just making sure that you're doing everything that you can to keep clean financials. Everyone needs an exit strategy from this space at some point or another. Keeping clean and accurate financials and not getting behind in tax payments is a great way to make sure that you get the best bang for your buck when it does come time to sell.
Sweet. Next question we have here is just some clarification on short-term capital gains versus individual tax. So what I understand, and again, not a tax professional, but the long-term capital gains tax rate is usually going to be lower than that ordinary income tax rate. The ordinary income tax rate can sometimes be around 37%. Where the long-term capital gains, that's dependent on what you do as a contractor and how you manipulate, certain numbers. But usually, even at the higher end, that's around like 20%. Yeah. So you usually can make out better if you do the long-term capital gains versus just, the ordinary income. That's why I was hinting at suggesting maybe if you're selling, at least owning it for a year so that you can take advantage of the long-term capital gain tax bracket.
Yeah. There's a lot of things that we should unpack there. The short-term capital gains is very specific. That's when you've sold an asset that you've owned for 1 year or less. That's the only time that comes into play. Short-term capital gains, you're going to be taxed like ordinary income. So whatever tax bracket you fall into, I think tax brackets right now are like 10 to 38%, somewhere in there, depending on your earnings. Whatever bracket you're in, add your capital or your whatever your sale price for the asset was to your income, whatever bracket you fall in there, that's the rate that you pay on that. There's no additional rates added on to that. Anything you own for a year or longer, you're going to be subject to your standard capital gains or the long-term capital gains tax. That's going to mean a number of different things, and it's going to be heavily dependent. I don't know that I can think off the top of my head what the rate is for that, because I think the rate fluctuates, but the capital gains tax is going to specifically be set off of the purchase price when you acquire that asset, and then the sale price when you sold that asset, and the time that you owned the asset in between those two points. So it's a very fluctuatory number. I couldn't even begin to try to project out what that's going to mean for someone and someone who's going to realize those taxes. But that's the difference between short-term and long-term, and how those will be taxed as ordinary income or capital gains.
Gotcha. I know you touched on it a little bit earlier, but I'm kind of interested to see what else you have to say. Doing an asset sale versus a stock sale, kind of pros and cons there for any of our buyers here, just wanting to learn more outside of, just the tax differences. But if you want to run through some pros and cons, I think it'd be super helpful.
Yeah, absolutely. So stock sales, the big draw there is that we can normally get those done a lot quicker, right? We don't have to set up a new corporation. We don't have to go through a number of different checks and balances with FedEx specifically in the back office. In a stock sale, just so we're all speaking the same language here, that's going to be when you go in to buy a FedEx Ground business, but rather than buying the assets of it and housing those in your own corporation, you're going to buy the S Corp or C Corp that currently exists, and you're going to take everything, the accounts, the banks, the assets, the physical trucks and scanners and everything. The catch there is that, like I said, you're going to inherit the depreciation that the business was currently running. So if they have an older fleet that's been fully depreciated, you're not going to have that advantage right off the bat to implement into your own tax filings the year following. Additionally, we can introduce language into purchase agreements that you and your counsel can go through and make sure you tweak to what you like to try to avoid any obligations or lawsuits or anything that company may have taken on before you bought. But if we don't specifically nail those things down, you can take some of that on yourself. So it can't put you in a precarious situation if you and your attorney aren't really litigious in the way that you go through and redline that document. So to kind of summarize there, stock sales are speedier, right? But they do leave you open to a little bit more risk. And you do lose some of the more aggressive depreciation schedules that you can start should you decide to go through an asset sale. With an asset sale, yes, it does take a little bit longer because we're going to go through each and every single truck and scanner and the CSA and goodwill and all sorts of different things that go into those contracts and transfer those from the existing corporation to the new corporation. Yes, this is the majority of the deals that we broker, and we do it for a really specific reason. Like I had said, so that you guys can take full advantage of the depreciation schedules that are there to give you a clean and fresh start, and so that you have cohesive financials from the second you took over the business until you go to sell. And again, touching back to the exit strategy that I've harped on a little bit here today, it is very important that you not come into the FedEx Ground space without having an exit strategy. You should know if you want to be in this business for 2 years, for 5 years, for 10 years, or forever, because it's going to really, really change the way that you keep your records, that you run your business, and that you house everything inside of your corporation. So all of those things, they're very full encompassing strategy that you need to embark on when you're setting these things up. That's why I'm a little bit more partial to an asset sale. I like having a clean start. I like advising my people that I'm working with to keep their clean financials, to make sure that they're as aggressive as they can be on their depreciation schedules, because that's how you're going to maximize the return that this business can really provide to you as an investor.
Don't tell my clients that who are trying to close at the end of this month. I'm pushing the stock sale, Danny. It's the only
Hey, we've
way.
all been there. I did a stock sale this year in 10 days.
Oh my gosh.
That's
wow.
a record.
Yeah, that's pretty good. That's pretty good. I'll give you a little trophy for that one.
I want a big trophy.
Yeah, big one. I'll see what I can do. All right, I'll have one last question. Anyone else who's sitting on a question, go ahead and pop it in. Otherwise, we can end a little bit early today. But we talked a tiny bit about depreciation. Do you have any thoughts on like owning vehicles versus just doing like a leased program or something like that, and what tax implications that could have on a business?
Yeah, absolutely. So I'm always going to be partial to owned assets over leased assets. And we have seen in the market a little bit where leased assets can kind of diminish some of the saleability of the business, especially if it's one that we're trying to bank, through the SBA or a conventional lender. There's nothing wrong with having a leased fleet. If your CSA is conducive to it, it is a great way for you to have an exact measurement of what your repair and maintenance costs are going to be, what your CapEx is going to be going into your trucks. And it's a way to keep things really tight. It absolutely is. There are some states where interest paid on those leases and certain aspects of leases you can depreciate, but one of the best aspects and one of the more beneficial aspects of owning FedEx Ground routes is how advantageous they are in the tax world. And again, mostly because of the aggressive depreciation schedules that you can undertake in this business. With an owned asset, yes, that capital injection that you make is going to be a hit to your bottom line. But at the end of the day, the advantage of that in the tax side of things is so much better than that. And on top of that, having those own vehicles that are a little bit nicer and a little bit newer, great for your driver retention, great for your fuel efficiency, great for your overall appearance and how FedEx views you inside of the terminal. So I'm partial to owned assets versus leased ones, but there's a world where leased trucks are the right decision for specific CSAs.
All right. We got a couple others that just slipped in here last minute. I guess I gave them a second to hit that last minute submit. Danny, can you talk a little bit about the benefits of earning points with unassigned routes in the line haul space?
Oh, absolutely. So tractor points are earned every single day that you have a tractor available for a run inside of the terminal. You don't necessarily have to run an unassigned run to have that, but you get more points in that scenario. Tractor points are earned and stored, and they are a huge asset for every single FedEx Ground business, because when an unassigned run is being used so frequently inside of a terminal that it becomes dedicated, or new clients come into the fold in the freight space and we're going to dedicate more runs inside of a terminal, the terminal is going to go out to the line haul operators that are present and say, hey, we've got this opportunity available. Who wants to bid on it? And you go into FedEx, you say, hey, here's my RFI, here's my business plan, here's the tractor, here's the drivers. And on top of that, I've got, 5,000 or 10,000 or whatever it is, tractor points. Tractor points are a huge factor in the bidding process, because the more tenured operators are going to have more tractor points available. More tenured operators tend to be more successful operators. So a terminal is going to look at a number of factors there: safety scores, service scores, what tier you're in on that safety level, and then how many points you have to bid on that run. So you can go from having the unassigned run, which they do get used almost as much as a dedicated run, but they fluctuate, to a dedicated run in that unassigned run instead, where you have that guaranteed revenue and that guaranteed usage on a week-to-week basis.
Yep. All right, we got a couple more here. Danny, I don't know. I'm interested to see what you have to say about this, but can a buyer be a publicly traded corporation?
If you can't see, I'm kind of doing one of these. Yeah. Here's the deal: with a C corp, there will be stock involved, right? That's the whole reason that people engage in starting these businesses via a C corp, is they can sell stock of the FedEx contract back to their ROBS 401k or their 401k via the ROBS program, and that's how they replenish the funds that they borrowed from the 401k for their capital injection, right? To answer your question, I think the answer is probably no. You have to have one person dedicated to being the AO of the company. You have to have an S corp or a C corp, neither of which are publicly traded often. And that's that.
Yeah, you can have one person go in as the AO and then have, investors who are backing you, but I think that's a little bit different than what you're asking.
Yeah, I just talked about that scenario with an investor earlier today, where if there's multiple entities inside of a terminal and they have multiple people inside their investment group that want to be an AO, it's like you can do that and then have a housing entity, an entity that's all housed in a different corporation or a trust, or however you want to do that. Again, talk to your tax professionals and your CPAs about it. There's worlds where that can happen, but the buyer needs to be a person, and the person needs to have an S or a C corp. No negotiations on that.
Yeah, absolutely. Okay, you just kind of talked about this a little bit, but are there any considerations for using a retirement account to fund the purchase of a P&D business?
Yeah, absolutely. You can do it in P&D or line haul.
But
The
I
Rob's
hate doing it, by the way. I hate it. I'm just gonna tell
Listen,
you right now.
the Rob's 401k program has proven to be very, very beneficial to us as a brokerage, and to our buyers and sellers. I mean, there's a lot of validity to what you can do with that program. You can take funds via the Rob's 401k program and use it as your capital injection to achieve an SBA loan. Or if you have enough there, you can use that as a cash acquisition, and go through things that way. We have a couple of partners that we use on that. Guidant Financial is the main one that we use. Reach out to us if you're curious about it. I'd be happy to introduce you to a gentleman named Paul Cook. He's our friend over there. He's awesome at what he does. Listen, very few of our buyers are going to find it a viable option to use the Rob's 401k program. It's perfect for some people, and it's a nightmare for everyone else. Yes, there's a way you can do it, but it needs to be done the right way with the right people and the right intentions in mind, because you don't want to leave yourself stranded without a solid 401k as you get into those golden years. That being said, we've been very successful using the Rob's program in a number of deals, even this year, and historically even more so. Yes, you have to have a C Corp to do it. You have to have enough funds available to buy the business either in there or use that for a capital injection. And then you have to, set things up a little bit more intricately. But our partners at Guidant and the brokers or sales director you're working with here in house can help mitigate some of that craziness.
All right. Well, that is it for the Q&A today. If you guys are joining us on Friday, I will see you at our vendor back office. Danny, no, come on. Is there another one?
Do it real quick. It's for Zach. Come on, let me help him out here.
Okay, all right, Zach, I'll get to it. You just slipped in.
Do it for Zach. Come on.
Yeah, and I think he was the first question of the day too, so he kind of like got that awkwardness out of the way and put himself out there. All right, Zach, he says, I was referring to the seller financing portion of a sale. Post sale, the seller does not pay taxes on that seller finance portion immediately. Tax options for that portion are installment method, closed transaction method, open transaction method. Which method works best with seller financing at Route Consultant?
Yeah, thank you for the clarity, Zach. Yes. So traditionally, the way that we're going to structure this is on an installment method. Basically, we calculate simple interest, traditionally 6% over whatever the amortization period is. I typically stipulate, the first Friday of the month is when that EFT is going to be made. That's my preferred method because it's the most simple. I'm sure that we can get into the minutia of an open and closed transaction method, but I think that the installment method is ideal for this space and this ecosystem specifically. Traditionally, on the schedules and the structure of the seller financing, I really like to, if we're over, 100,000 or so in the seller financing bucket that we're using, I like to do a 10-year amortization schedule at 6% to keep the monthly payments lower at the start of the stand-up so that person has a little bit more cash flow there, with a 5-year balloon payment settling out the remaining principal. That's worked more often. That's worked for me, and that's more often than not what I structure specifically to the deals that I broker. But that's the beauty of seller financing, is you become your own bank. We can set the rules. We can set the rates where we need to. We can set the installments how we need to. We can set the amounts where we want to. It's completely open season, and we've gotten very creative with seller financing over the years. One caveat that I will add to it, if we're adding seller financing into a deal that's going to be structured with an SBA loan, more often than not, 2 to 3 year standby before the seller financing payments can be realized. Really what that means to you is on the 37th month of a deal, if it's a 3-year standby, you'll get your first seller financing payment. You can annually take on, simple interest for that. So, if you're at 100,000 and you're on a standby for a year, add 6,000, then that compounds simple interest annually until you start making those payments, and that would be your principal at that point.
All right. Done. No more questions. Just kidding. All right. You guys are keeping me.
I guess. Eugene, what's up, man? Let's talk about it.
Eugene, y'all are killing me today. This is great. Okay, he wants to know how much in total do you need on hand to buy a $600,000 business? I think Josh just talked about this a little bit last week. And what's the minimum that you need to have if it's an SBA loan?
Couple of great questions, and we do. I would encourage you, Eugene, go back into our YouTube channel and check out when Tucker Herring and I from G Bank went through all the SBA stuff. Every question you have about the SBA and FedEx Ground, we answered on that one. It is chock full of great stuff, and you get to see my handsome face some more. So hit it up. But to answer your question, for a $600,000 business, typically we're going to want to see a minimum of 10 to 20% liquid capital on hand, with the thought in mind that you're going to invest at least 10% of the purchase price at the closing table. When it comes to an SBA loan, minimum is we need 10% liquid injection for a 7A loan, right? But that doesn't all have to come from the buyer. We can use seller financing as the cash injection. So if you've got 5% seller financing and 5% cash down, boom, you've got your 10% and you're good to go at that point. But there's a lot of nuance to that. There's a lot of levers that need to be pulled to make that work. The business has to cash flow the right way. So go back and check out the video that we did with Tucker Herring. All the SBA questions are answered there in great detail. And Eugene, you can always reach out to us, info@routeconsultant.com. Ask them to connect you to me if you'd like to talk a little bit more. Always happy to set up a call with new investors to the space and people who are curious. That's what I'm here to do.
All right. I think I'm just like antsy to get off this because I need my afternoon.
You got to give them a going once, going twice.
Yeah. But even when I do that, I feel like it never works.
Guys, I'm calling it right now. That's the last of the Q&A.
Right.
Thank you for being here.
Now that you said it, Danny.
That's it. We're done. I called it. Full plug. Thank you all for joining us. Thank you.
It's always a pleasure. And hopefully I'll see some of you on Friday. So if not, we'll see you next Wednesday. Thank you so much.